Hello everyone and welcome. Today we are going to get into what I believe is the single most critical skill for anyone who wants to be a leader in business. And that's the ability to really understand and to speak the language of business. And that language, the one that works everywhere, in every industry, is accounting.
So let me just start by posing a question. I want you to picture a company. From the outside, it looks like it's just crushing it, right? They've got a hot new product everyone's buzzing about, they're in a beautiful, shiny office, and the CEO is all over the news giving these amazing interviews. But here's the real question. Is that company actually successful? How can you, as a future manager or maybe an investor, look past all that surface-level polish and figure out what's really going on with the company's financial health?
Well, that's where accounting comes in. This is the answer. And you have to understand, it's so much more than just crunching numbers or filing taxes. It's really a system. It's a process for taking all the messy, chaotic, day-to-day stuff that happens in a business, every single sale, every paycheck, every investment, and translating it all into a clear, standardized language that everyone can understand. And that language is what gives you and investors and banks the reliable insights you need to make smart decisions.
Okay, so here's our game plan for today. We're going to start by really cementing why this is the essential language of business. Then we'll get into the fundamental rules of that language, the grammar, if you will. After that, we'll see exactly how raw data gets turned into useful financial statements. Then comes the fun part. We'll apply all of it to a real-world decision. And we'll wrap up with some classic rookie mistakes that you're going to want to avoid. So let's dive right in. Why do we call accounting the language of business? And I really want you to look at that subtitle. I am not exaggerating when I say this might be the most important course you take. It doesn't matter if your goal is to be a marketing genius, an HR visionary, an operations guru, or to start your own company from scratch. Being fluent in accounting isn't just a nice little skill to have. It is an absolute non-negotiable for being an effective leader.
I mean, just think about the big decisions a company has to make. Should we drop millions of dollars on a brand new factory? Can we actually afford to give our team that raise they absolutely deserve? Is our cool new product line actually making us any money, or is it a drain on resources? Now, trying to answer these huge questions based on a gut feeling, well, that's a recipe for absolute disaster. Every single one of them demands a careful, evidence-based look at the financial data. And this, right here, is where accounting stops being some boring chore and becomes the actual foundation of business strategy.
Now, if you want to become fluent in this language, you have to understand its grammar. We need to know the core principles and assumptions that give it structure. Think of these like the rules of the game for financial reporting. They're the whole reason an investor in New York can look at the financials for a company in Tokyo and another one in Berlin and actually make a meaningful comparison. These rules, which in the US are called Generally Accepted Accounting Principles, or GAAP, are what ensure that everybody is playing by the same rulebook. So rule number one, and honestly, this is the big one, is the economic entity assumption. It's a really simple idea, but it's incredibly powerful. A business is its own separate thing. It is distinct from its owners. What this means in practice is that the company's money and financial activities have to be kept completely separate from the personal finances of its owners or managers. This isn't just some accountant's preference. It's a critical legal idea that protects owners from being personally on the hook for business debts. And just as importantly, it lets us see how the business is doing on its own terms. And here's a perfect, simple example of what I mean. Let's imagine the founder of our little company, Clarity Coffee Co., goes out and buys a fancy new sports car for herself. That car loan belongs to her personally. It is not the company's debt. So it has absolutely no business showing up on the company's financial statements. Keeping that line clear is just fundamental to good accounting and to accurately figuring out if the coffee shop itself is successful. Okay, next up is the monetary unit assumption. This one's got two parts. First, we only record things that we can actually measure in money, like US dollars, for example. The second part is a bit of a necessary fiction. We assume that the value of that dollar is stable over time. Now, wait a minute, we all know about inflation, right? A dollar today isn't worth what it was 10 years ago. But for the sake of simplicity in day-to-day accounting, we make this assumption. It allows us to add a transaction from January to one from December without getting bogged down in complex inflation adjustments. It just keeps the books manageable.
Now this highlights a really interesting tug of war that's always happening in the world of accounting. On one side, you have the historical cost principle. This says we record an asset for what we originally paid for it. The huge advantage here, it's objective. It's verifiable. We have a receipt. We have an invoice. There's no arguing about it. But on the other side, you've got the fair value principle. This says we should record assets at what they're worth today. Now, you could argue this is way more relevant for making decisions, right? But it introduces a huge problem, subjectivity.
I mean, how do you figure out the fair value of a one-of-a-kind piece of machinery? Because of that challenge, we usually stick to historical costs for things like buildings and equipment, and we use fair value more for things like stocks and bonds, where you can just look up the price online.
All right, so now that we've got the basic rules of the game down, we can start to look at the process. We can look at how they're actually applied. This brings us to the accounting cycle. I want you to think of this as the engine that takes thousands of individual business events and churns them into those clean, simple financial statements we need.
And it's a very systematic step-by-step process. Step 1, it all starts with recording every single transaction as it happens. Every coffee sold, every bag of beans bought, every paycheck paid. Then at the end of the month or quarter, accountants make what we call adjusting entries. This is for things that happen over time, not all at once, like the value of the espresso machine going down a little bit each month, or using up a month's worth of prepaid rent. After that, we're ready to prepare the big 3 financial statements. And finally, we close the books. That basically means we hit the reset button on accounts like revenue and expenses, getting them back to zero so we're ready to start the next period fresh.
So what's the whole point of this meticulous cycle? It all comes down to one word: reliability. By following these steps in this order every single time, we can be confident that the final reports are a true and accurate picture of what really happened with the company's finances during that period.
And now for the moment where it all comes together. Theory is great, but its real value is when you put it into practice. So let's step into the shoes of a manager. Let's take everything we've learned and put these numbers to work for our little company, Clarity Coffee Co.
So here's the scenario. The management team at Clarity Coffee is fired up. They've found what they think is the perfect spot for a second coffee shop. It's in a busy part of town, tons of foot traffic. It just feels like a home run. But there's a big but. To do it, they're going to have to take out a pretty sizable new loan. So the question on the table is simple. Should they do it? And as we've been saying, the answer can't come from just excitement or a gut feeling. The answer, or at least the clues to the answer, are buried in the company's financial statements.
Okay, so after the accounting cycle has done its thing, here is the simplified data that we have to work with for Clarity Coffee. We've got revenue, that's the total sales at $500,000. We've got net income, that's the profit after every single expense is paid at $50,000. We see cash from operations, which is the actual cash the business is generating at a very healthy $75,000. And last, we see total debt, what the company owes at $200,000. This little table right here, this is our entire decision-making toolkit.
All right, let's put on our analyst hats for a second and break this down. First thing I see, let's calculate the profit margin. That's net income divided by revenue. $50,000 divided by $500,000, that's a 10% margin. That's pretty strong. That's a good, healthy, profitable business. Even better, look at their cash flow. Their cash from operations is actually higher than their net income. That is a fantastic sign. It tells you they are really good at turning their paper profits into actual cash in the bank. But, and this is a big but, look at that debt. At $200,000 of debt against $50,000 of income, their debt is 4 times their annual profit. That's getting up there. That's a sign of risk. So the real question becomes, can this company handle piling even more debt on top of that to fund this new shop?
So after that analysis, the smart, data-driven decision here isn't a simple yes or no. It's a strategic not yet. The numbers are practically screaming at us to be careful about the current debt load. The most responsible business decision is to put the brakes on the expansion, maybe for just 6 months, and use that fantastic cash flow they're generating to hammer down their existing loans. By doing that, they lower their risk and they put themselves in a much, much stronger position to expand a little further down the road.
Okay, before we wrap this up, I want to leave you with some practical advice. I want to talk about a few of the most common and most dangerous mistakes that I see people make when they're just starting out. Think of these as some pro tips to keep in your back pocket for your future careers.
First, and please burn this into your brain, never, ever confuse profit with cash. You can have a company that is wildly profitable on paper, but if your customers aren't actually paying you, you will run out of cash and you will go bankrupt. Cash is the oxygen a business needs to survive. Second, you have to be a detective. Always look for the story behind the numbers. Don't just see high debt and think bad. Ask why. Was that debt used to buy an amazing new piece of equipment that will make them more money for years to come? Or was it to cover losses? Context is everything. Third, never fall in love with a single number. Just like we saw with Clarity Coffee, a great profit margin is nice, but it doesn't tell you the whole story if debt is through the roof. You have to look at the whole picture. And finally, don't forget the principles we talked about today. Those rules exist for a reason. They're the foundation of good analysis, and they will keep you from making really big mistakes.
I want to leave you all with this final thought. It's really easy to think of accounting as just a history lesson, right? A dry record of what's already happened, but that misses the entire point. The real power of this language is its ability to shape the future. Financial statements are not just a rear-view mirror showing you where you've been. When you really learn how to read them, they become a map that shows you where the business can go. They are the tool that will allow you as future leaders to navigate challenges, to make smart strategic choices, and to chart a course for success. So I really encourage you, embrace this language, learn its grammar, and use it to go out and build something incredible.